The crypto market is at a critical turning point, and you need to see what's happening right now. The latest U.S. jobs report came in shockingly low, and everyone is now watching the Federal Reserve with a massive interest rate cut expected on September 17th. This could be the fuel that ignites the next epic bull run. While Bitcoin is fighting to hold the crucial $110,000 level, its dominance is dropping, signaling that the long-awaited altcoin season is about to begin. We're hearing wild predictions from top analysts, including Arthur Hayes calling for a $20,000 Ethereum. This isn't just another market update. These are breaking developments that could define the next 12 months for your portfolio. Are you prepared for the volatility and the massive opportunity ahead? The next few weeks could change everything. In the latest video from Altcoin Daily, the discussion kicks off with some tough news for the U.S. economy. The August jobs report was a big miss, with only 22,000 jobs added compared to an expected 76,500. To make matters worse, June's numbers were revised to show a loss of 13,000 jobs, the first time the economy has shed jobs since the pandemic. This economic weakness is fueling talk that the Federal Reserve will have to cut interest rates soon, which is generally seen as a positive sign for crypto. The video lays out a very optimistic case for the crypto market, tying its future performance to macroeconomic factors like a weakening job market forcing the Fed's hand on rate cuts. The August jobs report was indeed as weak as described, which has increased market expectations for a rate cut at the Fed's September 17th meeting. Currently, Bitcoin is trading around $110,000 to $111,000, and Ethereum is near $4,280, so reaching the year-end targets of $200,000 for Bitcoin and $10,000 to $12,000 for ETH would require a massive surge in the final quarter. In the latest video from the Crypto Rover channel, the discussion centers on Bitcoin's next potential move following the release of important economic data from the United States. Rising unemployment figures suggest a weakening economy, making it highly probable that the Federal Reserve will cut interest rates at its next meeting. Such cuts are typically bullish for assets like Bitcoin. The video points out that while the S&P 500 and gold have been reaching new all-time highs, Bitcoin has been lagging. The video's analysis hinges on the Federal Reserve's reaction to a weakening economy, and recent data seems to support this view. The August jobs report was notably weaker than expected, with only 22,000 non-farm jobs added, far below forecasts. The unemployment rate subsequently ticked up to 4.3%. This has solidified expectations for a rate cut at the next Fed meeting on September 17th. With markets now pricing in a very high probability of at least a 25 basis point cut. In the latest video from the Crypto Tips channel, the discussion centers on a very bullish short-term chart for Bitcoin while also touching on several major economic topics. The speaker argues that interest rate cuts aren't needed for a Bitcoin rally, pointing out that the market bottomed in November 2022 and then climbed despite 5 consecutive rate hikes. He suggests that coming rate cuts will only devalue the U.S. dollar and hurt the middle class, who often don't have inflation hedges like Bitcoin. The video also brings up the growing role of AI in the workforce, citing a statement from Coinbase CEO Brian Armstrong that 40% of the company's code is already AI-generated, with a goal of 50% by October. This leads to advice for viewers to find jobs that AI cannot easily replace and to invest in Bitcoin as a long-term safeguard. The video's focus on the U.S. debt situation and the declining appeal of the dollar is particularly timely. The U.S. national debt has indeed surged, recently adding $1 trillion in just 48 days, pushing the total close to $40 trillion. This rapid increase forces the Treasury to issue more debt. And if foreign demand wanes as the video suggests, it puts more pressure on the Federal Reserve. This macro environment is a double-edged sword. On one hand, a weakening dollar and fears of a debt spiral could push more investors toward assets like Bitcoin, as the video argues. The de-dollarization trend among BRICS nations, which are actively creating alternative payment systems and trading in local currencies, adds weight to this argument. In the latest video from Lark Davis, Tom Lee from Fundstrat lays out a case for a new 10-year bull market. He argues that demographics are a huge driver for markets, pointing out that generational peaks in the workforce often line up with major market tops. With baby boomers peaking around 1999 and Gen X around 2018, he projects that the millennial peak won't happen until roughly 2035, suggesting a long runway for growth. Another major factor is the massive transfer of wealth, estimated to be up to $84 trillion, that will move to millennials and Gen Z. These generations are expected to have a much higher preference for equities and crypto. Lee also warns against recency bias, the pessimism lingering from the COVID era, and suggests the unbiased view is to look for assets with growth potential, much like buying tech stocks after the dot-com bust was the right move. The presentation isn't just a solo opinion, it's supported by other analysts. Vim Clements sees a decade-long bull market emerging in Europe, while strategist Ed Yardeni is targeting the S&P 500 to hit 7,700 by 2026 and potentially 10,000 by the end of the decade. A Morgan Stanley analyst also agrees that a new bull market cycle began after the sell-off in April. Tom Lee's decade-long bullish forecast, hinging on demographics and technology, presents a compelling long-term narrative that contrasts sharply with the market's current choppiness. Right now, the S&P 500 is trading around 6,481, which means Ed Yardeni's target of 7,700 by 2026 feels ambitious, but not entirely out of reach given the right conditions. The crypto markets are showing similar signs of short-term uncertainty. Bitcoin is currently navigating the $110,000 level after a volatile week, with some analysts seeing potential dips to the $100,000 to $104,000 range as key support zones. Ethereum is holding around $4,300, with traders watching to see if it can break resistance near $4,550 to make a run for $5,000. This near-term hesitation is fueled by macroeconomic factors, like the recent weak jobs report and the anticipation of an interest rate cut from the Federal Reserve later this month. In the latest video from Ben Cowan, he discusses the recent jobs report, which showed the unemployment rate rising to 4.3% and a surprisingly low addition of only 22,000 non-farm payroll jobs. A key point was the revision of June's payroll numbers to negative, a significant sign of a softening labor market. This weakness makes a Fed rate cut in September highly probable, with traders now even considering the small possibility of a 50 basis point cut. Cowan connects this economic data to historical market cycles for Bitcoin and the S&P 500, suggesting the weakening labor market could be the narrative for a 2026 bear market. He anticipates that before a major top forms, both the S&P and Ethereum will likely pull back to their 21-week moving averages around late September or early October, setting up one final rally into late 2025. He also predicts Bitcoin dominance will rise amidst this uncertainty and that silver could reach $50 before its current cycle ends. Ben Cowan's analysis connecting the weak jobs report to a potential 2026 bear market narrative is a compelling take on cyclical history. The data he cites, particularly the rise in unemployment to 4.3% and the meager 22,000 jobs added, has clearly shifted market expectations, with major banks now forecasting multiple rate cuts by year-end. This bad news is good news scenario, where a weakening economy forces the Fed's hand, often provides short-term fuel for risk assets. We're seeing this play out as Bitcoin hovers around $110,900, showing volatility but holding key psychological levels after the report. In the latest video from Coin Bureau, the host explains how the recent passage of the Genius Act in the U.S. has created a ripple effect across the globe, forcing other nations to solidify their stance on stablecoins and central bank digital currencies, CBDCs. The European Central Bank is now considering launching a digital euro on a public blockchain like Ethereum or Solana to compete with the flood of digital dollars. This is a significant shift from their original plan of a private permission system. The video suggests a final decision on the digital euro could come by the end of 2025. In Asia, China is reportedly exploring a yuan-backed stablecoin, likely to be tested in Hong Kong, to counter the dominance of US dollar-backed stablecoins. This is happening while their domestic ECNY continues to expand. Japan is also making moves by approving its first yen-pegged stablecoin, JPYC, and is planning a major crypto tax overhaul that could see the current 55% tax on gains slashed to a flat 20%. South Korea is not far behind, with 8 of its largest banks planning to launch a yuan-backed stablecoin by early 2026. The video also touches on India's steady progress with its digital rupee, which has seen circulation reach over $115 million by March 2025. On the other hand, countries like Canada, Australia, and the UK are taking a more cautious approach, with some pausing their retail CBDC plans due to a lack of public interest. The U.S. Genius Act itself, while providing a regulatory framework, effectively outsources the surveillance and control aspects of a digital dollar to private companies who will be required to comply with the Bank Secrecy Act. The video's depiction of a global scramble to regulate stablecoins and develop CBDCs in response to U.S. legislation is a fairly accurate reflection of the current geopolitical landscape. The Genius Act, though fictional, represents the kind of regulatory clarity the industry has been seeking, and its ripple effects are plausible. For instance, the European Central Bank's renewed push for a digital euro, with a potential 2029 launch, underscores the concern over the dominance of non-EU payment providers and US dollar-backed stablecoins. Similarly, China's consideration of a yuan-backed stablecoin to be trialed in Hong Kong aligns with its broader strategy to internationalize the renminbi and counter the dollar's influence. In South Korea, the move by major banks to launch a one-pegged stablecoin by 2026 is a direct reaction to the overwhelming dominance of US dollar stablecoins in the market. Japan's significant proposed tax reduction from 55% to 20% on crypto gains is a clear signal of its intent to become a more attractive hub for digital assets. India's digital rupee pilot has also shown considerable growth, with circulation reaching 1,016 Indian rupees crore by March 2025. What's particularly interesting is the emerging dichotomy. While some nations are accelerating their CBDC and stablecoin plans, others are. In the latest video from Crypto's Russ, the host digs into why Bitcoin and crypto took a hit while the stock market actually climbed. The main culprit appears to be Nasdaq, which has decided to tighten the leash on crypto-related companies on its exchange, demanding things like shareholder votes for buying crypto and deeper audits. This move spooked the market because it's not really Nasdaq's job to act like a regulator. That's what the SEC and CFTC are for. As a result, stocks for companies heavily into crypto, like MicroStrategy, saw a drop. Meanwhile, the broader stock market got a boost from weak ADP job numbers, which makes future interest rate cuts more likely. The video also mentions that MicroStrategy could potentially be added to the S&P 500, which would be a huge plus for the company. On a side note, World Liberty Financial reportedly blacklisted a wallet connected to Justin Sun because of some large, questionable token movements. Nasdaq's decision to impose stricter rules on crypto treasury companies is a fascinating, if not confusing, development. It feels like an overstep, especially just days after the SEC and CFTC issued a joint statement encouraging a clearer path for spot crypto products on regulated exchanges. This could be Nasdaq trying to front-run regulation and position itself as the safe exchange for crypto-related equities. However, it creates friction and uncertainty at a time when official regulators are signaling a more collaborative approach. The immediate negative reaction in crypto-related stocks, while the rest of the market rallied, shows just how sensitive this niche is to perceived regulatory threats. In the latest video from Crypto Banter, the host breaks down Kinetic, a liquid staking protocol built on Hyperliquid that has quickly gathered around $1.8 billion in total value locked TVL since its launch in July. Kinetic has become the main liquid staking option on Hyperliquid, capturing almost the entire market share. A standout feature is its plan to let anyone launch their own perpetuals market without needing to stake 1 million HYPE tokens, which is currently valued at about $47 million. Instead, Kinetic will function like a Kickstarter, allowing users to propose ideas and crowdfund the necessary capital. The analysis presented in the video offers a compelling bull case for Kinetic, especially by drawing parallels to Jito's success. The comparison seems reasonable given that both are liquid staking protocols on high-throughput chains, and Kinetic's TVL is already substantial, sitting at over $1.8 billion. The idea of a perpetuals launchpad is particularly interesting as it could create a new revenue stream beyond the typical 2 to 4% staking rewards seen with Hyperliquid. This could justify the host's estimated FDV of $750 million to $1 billion. The broader crypto market appears to be in a state of cautious optimism, with Bitcoin hovering around $110,000 and expectations high for a Federal Reserve rate cut, which could inject more liquidity into riskier assets like altcoins. The strategies mentioned for earning points carry different levels of risk. The Pendle Finance approach is especially aggressive. It's a direct bet on the future value of an airdrop. While potentially very profitable if the host price per point prediction of $10 to $20 holds true, it's also a strategy where the entire principal can diminish as the yield token's maturity date approaches. The LP strategy with Pump offers a high APY but exposes users to the volatility of two different assets. The simple staking method is the most straightforward but offers the lowest relative return. This all comes at a time when DeFi is seeing renewed interest, and innovative platforms on chains like Hyperliquid are attracting significant attention. In the latest video from Crypto Casey, she explains that while Bitcoin recently dropped to around $18,000, its lowest point since July 8th, the overall market trend remains bullish. A weekly close below $14,000 would be the signal for a bearish turn. A key indicator that the much-anticipated altcoin season is approaching is the flow of money from Bitcoin into major altcoins like Ethereum and Solana. This rotation of capital is a historical pattern, moving from large cap to medium and eventually small cap coins. The video warns viewers that this period will be extremely volatile, with significant price swings including pullbacks of 40% or more. The central strategy is to follow the trend and remain bullish but to consistently take profits. Another major signal is that Bitcoin's market dominance is falling below the 60% level, a pattern also seen just before the 2021 altcoin season. On the macroeconomic front, the Federal Reserve is expected to cut interest rates at its September 17th meeting, an event that has historically been good for crypto prices. While September is often a down month for Bitcoin, the fourth quarter and October in particular is typically strong. The video's core idea that we're on the verge of an altcoin season driven by falling Bitcoin dominance and a potential Fed rate cut holds up well against current market conditions, though some of the specific numbers in the transcript are dated. Bitcoin is currently trading significantly higher than the $18,000 mentioned, hovering around $110,871. Ethereum is trading near $4,300, and Solana is strong, recently clearing the $200 mark. The video correctly identifies that a drop in Bitcoin dominance signals a shift to altcoins. Currently, Bitcoin's dominance is sitting around 55 to 58%, which is lower than the 60% threshold mentioned and shows capital is indeed flowing into other assets. The upcoming FOMC meeting on September 16th to 17th is a focal point for the market, with a very high probability, over 97% according to the CME FedWatch tool, of a rate cut, which could inject more liquidity into risk assets like crypto. Furthermore, the regulatory environment in the U.S. is showing positive signs. Recent proposals from the SEC aim to create clearer rules for digital assets, potentially reducing compliance burdens and integrating crypto into traditional financial systems, which could boost institutional confidence. While September can be a historically volatile month, the combination of a dovish Fed, clarifying regulations, and capital rotation into strong large-cap performers like Solana and Ethereum supports the video's bullish outlook for the remainder of the year. In the latest video from DataDash, host Paul Sampson gives a technical look at Bitcoin and Ethereum, explaining that the market spends about 80% of its time moving sideways in ranges. For Bitcoin, he points out that the price has been hovering around the $110,000 mark after starting the week near $107,000 and pushing up to $112,500. He explains his strategy of watching the previous week's high and low points to find trading opportunities. Sampson noted that the price recently dipped below last week's low of around $107,300, which likely cleared out stop-loss orders from traders who went long over the weekend before bouncing back up. He thinks Bitcoin will likely move higher, possibly to the $115,000 to $120,000 range, as long as it stays above the $107,000 support level. For Ethereum, a similar pattern was observed. The price swept below the previous week's low, hitting the monthly average price before recovering. Sampson sees this as a good entry opportunity. He mentions there's still an unfilled weekly target for Ethereum up at $40,600. As long as ETH holds above $4,200, he anticipates a move towards that target and potentially onto new highs between $5,100 and $5,600. Paul Sampson's technical analysis of Bitcoin's range between roughly $107,000 and $112,500 captures the market's current indecisive state well. As of today, Bitcoin is trading right in the middle of that zone, sitting around $110,000. This choppy sideways action aligns with his view that markets spend most of their time in consolidation before a bigger move. The support level he identified at $107,000 appears to have held earlier in the week, lending credibility to his technical setup. Similarly, Ethereum is trading around $4,280, just above the $4,200 support level he mentioned is critical for a potential push towards $4,600. In the latest video from Crypto Wendy, she talks about how traditional finance is scared of crypto, especially Ripple's XRP. She points to a LinkedIn post where the CIO of Swift criticized XRP, saying that just surviving lawsuits doesn't make a company resilient. The host disagrees completely. She argues that traditional banks control everything, forcing people to use their systems while they invest customer money however they want. The video's argument that traditional finance feels threatened by Ripple is a long-standing narrative in the crypto community, and recent events add some interesting layers to it. The core of the video's point is that Swift sees Ripple as a direct competitor. While Swift's CIO publicly dismisses Ripple, Swift's own actions show they're not ignoring the technology. They are actively running pilots for digital asset transactions and CBDC interoperability, set to go live in 2025. This suggests that instead of being terrified into inaction, they're building a competing system to retain their central role in global finance. In the latest video from The Modern Investor, the host discusses the growing anticipation for an altcoin season. Many analysts and institutions are now predicting that altcoins could see gains of 5x to 10x. This period, often called alt season, officially begins when 75% of the top 50 altcoins perform better than Bitcoin over a 90-day stretch. A key sign of this shift is a drop in Bitcoin's market dominance, which typically falls to between 25% and 40% during these times. According to a Coinbase analyst named Duong, there's a lot of money from everyday investors waiting to enter the market, which could be triggered by easing from the Federal Reserve. The host also points out that a rise in Google searches for buying crypto is a classic sign of new retail interest. The conversation then turns to Arthur Hayes, the co-founder of BitMEX, who has gained a following for his accurate market calls. Hayes has made a bold prediction that Ethereum's price could reach $20,000 during this cycle. This prediction is supported by a sudden and massive wave of institutional interest in Ethereum. Several large companies have announced plans to buy billions of dollars worth of ETH, and BlackRock's Ethereum ETF saw significantly higher inflows than its Bitcoin counterpart. The host concludes by noting how unusual it is for so many different analysts to agree on such bullish price targets for major cryptocurrencies like Bitcoin, Ethereum, and XRP. The videos focus on an impending altcoin season, and Arthur Hayes' $20,000 Ethereum prediction is capturing a very real sentiment in the market. Currently, Ethereum is trading around the $4,300 to $4,400 level, making the $20,000 target a nearly 5x jump from its present valuation. While ambitious, the institutional groundwork mentioned in the video is visible. For instance, August 2025 saw Ethereum ETFs pull in a massive $3.95 billion in net inflows, while Bitcoin ETFs actually saw outflows of $301 million. However, the start of September has seen some of this reverse, with Ethereum ETFs recording significant single-day outflows of over $447 million, suggesting some investors are taking profits. In the latest video from Alex Becker's channel, he grabs your attention with a title about selling all his crypto, but he's not selling today. Instead, he lays out a plan for when to sell in the future, predicting a huge crash is on the horizon after the current bull run hits its peak. He describes the classic crypto market cycle: first Bitcoin runs, then liquidity flows into Ethereum, followed by the top 25 altcoins. After that, money moves into mid-cap coins focused on DeFi and infrastructure, then smaller caps and narratives like AI and real-world assets (RWA). And the final signal of the top is a massive meme coin frenzy. Becker's focus on social sentiment over technical charts as a top indicator is a classic contrarian viewpoint that has served many well in past cycles. Currently, the market reflects a mix of caution and optimism. Bitcoin is hovering around $110,000, facing key resistance, while the Fear and Greed Index is neutral at 48. This doesn't align with the euphoric, aggressively bullish sentiment Becker describes as a market top. We're not seeing widespread mockery of bearish outlooks. Instead, there's a healthy debate, with some analysts calling for a correction before the next major leg up. In the latest video from CryptoJeb, the host explains his new short-term bearish stance on Bitcoin. He believes the crucial $112,000 support level is in danger of failing. Previously, a drop to this level was met with a strong bounce, but now the price is lingering below it for longer, suggesting weakness. A recent dip to $110,600 was caused by a whale selling 27,000 Bitcoin. The analysis presented in the video captures the market's current tension well. Bitcoin is currently trading around $111,183, struggling to hold the level Jeb identified as critical. The market appears to be in a consolidation phase after a recent drop, with traders watching for the next decisive move. The CME gap remains a significant factor, with a recent gap identified at $110,680, making the zone a magnet for price action. This aligns with the video's thesis that failure to reclaim higher levels could lead to a test of lower supports.